Good morning, children. This is part 13 of the chapter Admission of a New Partner. In this video, we are going to study about adjustment of capital accounts. Sometimes it happens that on the admission of a new partner, it is decided that the capitals of the old partner will be adjusted on the basis of new partner's capital to make them proportionate to their share of profits. Sometimes basically we adjust either the capital of old partners on the basis of new partner, or we calculate the proportionate capital of the new partner on the basis of old partners. So adjustment of capital is of two types as discussed. The first one, adjustment of old partner's capital on the basis of new partner. That means whatever the capital new partner is bringing, on that amount we will calculate the actual capital required of the old partners. And the second type is calculation of new partner's capital on the basis of old partner's capital. In this case, the capital to be brought in by the new partner is not given in the question. You have to calculate his proportionate capital on the basis of the old partner's capital. Let us discuss the first type, that is calculation of new partner's proportionate capital on the basis of old partner's capital. So here we are calculating the proportionate capital of new partner. The word proportionate is very important. And here in such type of questions, the capital of the new partner will not be given. Rather, the question will ask you to calculate his proportionate capital on the basis of old partner's capital. So let us see what will be the steps. If the new partner is to bring capital in proportion to his share in profit, then in that case, capital to be brought is the amount determined on the basis of the total capital of old partners, which comes after all the adjustments. That means the proportionate capital of the new partner will be calculated on the basis of capitals of the old partners after making all the adjustments regarding the revaluation, regarding the goodwill written off, etc. For this purpose, following steps are taken. Step number 1. Find out the total adjusted capital of old partners, including undistributed profits and undistributed losses as from partners' capital account. That means, first of all, the very first step while calculating the proportionate capital of the new partner is that we have to calculate the corrected adjusted capital of all the old partners. Adjusted capital means after making all the adjustments given in the question regarding undistributed profit, undistributed losses, etc. That means we can say the figures, the balancing figures shown or depicted by partners' capital account. Then step number 2 will be find out new capital of the firm. That is total adjusted capital of old partners multiplied by new partner's share multiplied by reciprocal of the remaining share. So this formula will be applied to calculate the new capital of the firm on the basis of old partner's capital. What will be the formula? The formula will be total adjusted capital of the old partners as depicted by the capital account multiplied by the new partner's share. That means for the share which new partner is coming, multiplied by reciprocal of the remaining share. For example, if partner C is coming for 1/5 share, so let the share be 1. If we are giving 1/5 out of 1 to C, the remaining is 4/5, and the reciprocal of 4/5 will be 5/4. The numerator will become the denominator and the denominator will become the numerator. So in such a case, the formula would look like total adjusted capital of old partners, whatever the amount is of different partners, multiplied by new share. For example, 1/5 multiplied by reciprocal of the remaining share, that is 5 by 4 as in our example. After calculating the new capital of the firm on the basis of old partners' capital, the step number 3 will be, the final step will be on this, that means on new capital of the firm, we will find out the new partners' capital. And how we will calculate? The formula will be total capital of the firm as calculated in step number 2 multiplied by new partners' share. That is, for example, 1 by 5 for the example which we were discussing. So there are 3 steps for calculating new partners' proportionate capital. The word proportionate is very, very important. Either the question would ask you that calculate new partners' proportionate capital, or it might ask you calculate new partners' capital on the basis of old partners' capital. So in that case, we will apply these 3 steps. And then we will pass the entry for capital brought in by the new partner as we used to do it. That is bank account debited to new partner's capital account. Let us discuss an example to make it more clear. The example which I have taken here is the practical question number 65 from your book. The question says, name and came sharing profits in the ratio of 3:2. Admit Prem as a partner with 1/3 share in profits. That means there are 2 old partners, name and came, and they are accepting a new partner as Prem for 1/3 share. He had to contribute proportionate capital. Now, word proportionate is given. That means which case will apply? That means we have to calculate Prem's capital on the basis of old partners' capital. They had following financial position. On the date of admission, it was the balance sheet of the old partners. On the liability side, you can see creditors, then reserve fund of 50,000. This reserve fund is an undistributed profit. If further adjustments are not given in this case, then it will be distributed as undistributed profit among the old partners in the old ratio. It will increase their capital balance, therefore it will be shown on their credit side of their capital account. And if we pass the journal entry, then the journal entry will be reserve fund account debited, as we have already discussed in previous parts, to old partners capital account in the old ratio. Then the capital of name and came is given. This is the opening balance which will be shown on the credit side of partners capital account. Then on the asset side, you have cash at bank, debtors, stock and plant and machinery. They agreed to admit Prem as a partner on the following terms. The first term is plant and machinery to be reduced by 10%. That means you have to reduce the value of plant and machinery by 10%. So the value of plant and machinery is 80,000. So 10% of 80,000 will be 8,000. So here the value of plant and machinery, or that is asset, is going down, decreasing. Therefore, this reduction of 8,000 will be shown on the debit side of revaluation account. And if we have to pass the journal entry, then the journal entry will be revaluation account debited to plant and machinery account, 8,000 on debit side and 8,000 on credit side. And ultimately, when we will prepare the new balance sheet after admitting Prem, in that case we will show the value of plant and machinery as 72,000, that is 80,000 minus 8,000. Then point number 2, stock to be increased by 3,000. So the value of stock is 35,000. It has to be increased by 3,000. So this 3,000 is an increase in asset. It will be shown on the credit side of revaluation account by stock 3,000, and the journal entry for this will be stock account debited 3,000 to revaluation account 3,000. And when we will prepare the new balance sheet of the new firm, in that case on the asset side we will show the value of stock as 38,000, that is 35,000 plus 3,000. The third point is bad debts provision was to be created at 5 5%. There was no provision, we have to create it by 5%. So provision for bad debts is created on debtors. The value of debtors is 60,000. So 5% of 60,000 will be 3,000. So creating a provision means you are creating a liability. So this creation of liability is an increase in liability which will be shown on the debit side of revaluation account as to provision for bad debts, rupees 3,000. Then while preparing the new balance sheet of the new firm, you will show the value of debtors as 57,000, that is 60,000 of debtors minus 3,000 provision. Then the fourth term, accrued income not appearing in the books, rupees 900. Accrued income, that means outstanding income. So there is an unrecorded asset because outstanding income is an asset. So if you have not recorded the asset beforehand, you will record it now, and while recording unrecorded asset, it will increase the asset. It will be shown on the credit side of revaluation account. You will write by accrued income 900, and while preparing the new balance sheet of the new firm, it will be shown on the asset side as accrued income rupees 900. The fifth point. Prem was to introduce rupees 20,000 as premium for goodwill for 1/3 share of the future profits of the firm. So Prem was to introduce 20,000 as premium for goodwill and his share was 1/3. So this goodwill brought in by Prem, the entry will be bank account debited 20,000 to premium for goodwill account 20,000. And this 20,000 will be distributed among the sacrificing partners in the sacrificing ratio. Since in this question no information is given about the sacrificing share or the new PSR so that we can calculate, therefore we will assume the old ratio to be the sacrificing ratio. That means this premium for goodwill of rupees 20,000 will be distributed among name and came in the ratio of 3:2. The entry for this will be premium for goodwill account debited 20,000 to name and came in the ratio of 3:2. And as already before the balance sheet it is given that we have to calculate the proportionate capital of Prem, the new partner. You have to prepare profit and loss adjustment account, capital accounts and the balance sheet of the new firm. You also have to calculate the new profit sharing ratio. So in this question you don't have to pass the journal entries, but we have discussed it so as to make it more clear to you children. And you have to prepare the profit and loss adjustment account, capital account and balance sheet of the new firm. When we were discussing revaluation account, I already taught you that revaluation account is also known as profit and loss adjustment account. So that means here you have to prepare revaluation account, capital account and balance sheet of the new firm, that is after the admission of Prem. And you also have to calculate the new profit sharing ratio. In this case, since no information about the sacrifice is given, so while calculating new PSR, what we will do, we will assume the share to be 1, and after giving 1/3 of 1 to Prem, the remaining share, that is 2/3 or 2/3, will be distributed among the old partners in 3:2 to make it as the new PSR. Let us have a look at its solution. I have already explained you the question. Now let us see the solution. The first part, as you can see, is profit and loss adjustment account, or we can say revaluation account. So on the credit side we have shown buy stock, that is the increase in stock by rupees 3,000. Then by accrued income, this is recording of an unrecorded asset 900. On the debit side, we have shown to plant and machinery, that is the reduction of 10%, 8,000. Then to provision for doubtful debts, that is an increase in liability by 3,000, that is 5% of the debtors. So after posting all the increase and decrease in the assets and liabilities, we will compare the debit side with the credit side. So as we can see, in this case, the debit side is more than the credit side. Therefore, there will be a revaluation or profit and loss adjustment loss account, which will be distributed among name and claim in the old ratio of 3:2. So there is a revaluation loss of 70,100, which will be distributed among name and claim in the ratio of 3:2, which will come to name 4,260 and claim 2,840. So this was our revaluation account. Now we have to prepare the partner's capital account. As you can see, since we have to prepare the capital account of the new partner as well, so on the debit side we have shown particulars and the amount column for the three partners, and same we have shown on the credit side as well. So on the credit side, first of all, we have shown the opening balances. Since the opening balance was given on the liability side, therefore we have written it on the credit side. If it was given on the asset side, then we would have shown it on the debit side. So the opening balance of name and claim is by balance brought down, name 50,000 and claim 40,000. There is no opening balance of Prem since he is a new partner. Then we have distributed the reserve fund as undistributed profit, which will increase their capital, and therefore it will be shown on the credit side as by reserve fund name 30,000 and claim 20,000. Why? Because we have distributed reserve fund in the old ratio of 3:2, and since undistributed profits are distributed only among the old partners, therefore we have not given anything to Prem. Then thirdly, the premium for goodwill of rupees 20,000 brought in by Prem, since no information about sacrifice was given, therefore we have assumed that the old ratio is the sacrificing ratio, and therefore we have distributed the premium for goodwill of rupees 20,000 among name and claim. That means name has got 12,000 and claim has got 8,000. Then on the debit side, we have given them the revaluation loss as we have calculated from profit and loss adjustment account. Name is getting 4,260 and claim is getting 2,840. Now all the adjustments we have posted. The only thing is left is the proportionate capital of Prem. So for calculating proportionate capital, we need the adjusted capital of the old partners, that is name and claim, that we can calculate in this. We can compare the debit and the credit side, and after comparing it, we saw that the credit side is more than the debit side, and the closing balance of name, that is the adjusted capital of name, is coming as to balance carried down 87,740, and that of claim is coming to 65,160. So let us calculate the proportionate capital of Prem. As you can see here, we have calculated the calculation of Prem's capital we have done, that is combined capital of name and claim, that is the old partners, that is 87,740 plus 65,160, which came to rupees 1,52,900. So this is our step number 1, total adjusted capital. Then after that, the step number 2 is what we will do. We will apply the formula for calculating total capital of the new firm, that is the adjusted capital multiplied by, here we have multiplied the total adjusted capital of all partners multiplied by reciprocal of the remaining share, that is reciprocal of 2/3, which came to 3/2. So the total capital of the new of the old partners for calculating new partners capital is 2,29,350. So we will calculate Prem's or new partners capital on this firm's capital by multiplying it with his share, that is 1/3, which will come to 76,450. So that means the new partner is required to bring rupees 76,450 as his proportionate capital. So it will be shown on the credit side of his partner's capital account, that is by bank account, 76,450. And since there is nothing on the credit side except this, and there is nothing on the debit side, so the balancing figure will be 76,450. So as we can see, the closing balances of name is 87,740, Came is 65,160, and Prem is 76,450. Now let us see the opening balance sheet as at, since there is no date in the question, therefore I have not written any date. This is basically the balance sheet after admitting Prem. So as you can see, on the liabilities side, there was no change in creditors. So we have simply copied the amount of creditors as 40,000. Then we have shown the capitals of name, Came and Prem as calculated from partner's capital account, which is 87,740, 65,160 and 76,450. That is, the total capital is 2,29,350. On the asset side, let us see first the value of debtors, which is 57,000 after deducting provision, as explained you while explaining the question. Stock we have shown at 3,000 more because it was revalued. Accrued income 900, and plant and machinery 72,000, that is after depreciating or reducing it by 10%. Now coming over to the value of cash at bank. As you can see here, the value of cash at bank given at the before the admission of the new partner was 5,000, and after the admission of Prem, it has come to 1,01,450. Why? Because 5,000 was existing beforehand, and later on when Prem was admitted, he brought 20,000 for goodwill in cash and 76,450 in cash for his capital. So now the cash at bank will become, by combining all these amounts, it will become 1,01,450. So our balance sheet total will be 2,69,350 on the liabilities as well as the asset side. Now you can see the calculation of the new profit sharing ratio. Prem is given 1/3 share out of 1. That means remaining is 2/3. Names, now this remaining share 2/3 will be distributed among name and Came in the ratio of 3:2. So name will be getting 3/5 of the remaining share, which will come to 6/15. Came will be getting 2/5 of the remaining share, which will come to 4/15, and Prem share is 1/3. So you can see that the denominator and of name and Came is 15, whereas that of Prem is 3. So we will convert 3 into 15, for which we have to multiply 5 in the denominator, and the rule which we have discussed, that whatever we are multiplying in the denominator, the same has to be multiplied in the numerator as well. So it will become that is 1/3 into 5/5. That means it will become 5/15. So the ratio of name is 6/15, Came 4/15, and Prem 5/15. So the ultimately new profit sharing ratio will be 6:4:5. So this was the full-fledged question, children, in which there was concept of revaluation account, there was undistributed profit, there was proportionate capital calculation, there was the calculation of new PSR, etc. So I hope the question and the steps are clear to you, children. So based on this, I have given you the assignment. You have to answer the following questions in your register. Question number 1, you have to list down the steps for calculating new partner's proportionate capital on the basis of old partner's capital. So the step number 1 is you have to calculate total adjusted capital of old partners after adjusting undistributed profit, undistributed losses, etc. That is as per capital account. Then step number 2 is to calculate the partner's capital, new partner's capital. For that, either you can choose an indirect step, that is first to calculate the capital of the total capital of the firm, that is total adjusted capital multiplied by reciprocal of the remaining share, and then thirdly you can calculate new partner's capital on the capital of as calculated in step number 2. You will multiply it with new partner's share, or either you can combine step number 2 and step number 3. You can simply apply the formula total adjusted capital of old partners multiplied by reciprocal of the remaining share multiplied by new partner's share. It is up to you. And then question number 2, you have to redo the question taught in this video. That means you have to redo practical question number 65 from your book. And question number 3, you have to solve practical question number 66 from the chapter Admission of a Partner of Accounts book by D.K. Goel, volume 1. So go through the video once again, revise the steps, children, complete all the written work and practice more and more questions. Thank you, children. Take care.